We all remember the explosion. September 2008, the month the ATMs almost stopped working. The global economy had a heart attack, and we spent the next decade performing open-heart surgery to fix it. We passed thousands of pages of new laws. We handcuffed the big banks with strict regulations. We told the world, we fixed the system. It is safe now. We were lying to ourselves. We didn't actually fix the risk, we just evicted it. When the regulators squeezed the big banks, the money didn't disappear. It just moved into the dark. It migrated to a place where inspectors don't look and government guarantees don't exist. They call it the shadow banking system. It isn't run by mobsters. It is run by algorithms, pension funds, and unregulated lenders. Today, it controls nearly half of all the financial assets on Earth. It has grown into a $200 trillion monster that is feeding on free money, and unlike 2008, when this bubble bursts, there is no one left to bail it out. This is the story of the hidden cost of free capital. To understand how we built this doomsday machine, we have to go back to the crime scene. The post-crisis world of 2010, the Federal Reserve and central banks around the world were terrified. To keep the global economy from dying after the Great Recession, they slashed interest rates to near zero. They flooded the world with cash. For the first time in modern economic history, money was effectively free. But here was the paradox. While central banks were printing money, the actual banks, places like Wells Fargo, Barclays, or Citi, were terrified to lend it. New regulations, like the Dodd-Frank Act in the United States and Basel III in Europe, acted like a straitjacket. They forced traditional banks to hoard cash and avoid risk. If you were a startup looking for capital or a real estate developer looking for a loan, the bank door was slammed in your face. Yet, the demand for cash didn't vanish. Businesses still needed to make payroll. Builders still wanted to build skyscrapers. And most importantly, investors were starving. The people managing your 401k, your insurance payouts, and sovereign wealth funds could no longer make money on safe government bonds because the rates were zero. They were desperate for yield. They needed a return on investment, and they didn't care where it came from. This created a vacuum, a massive demand for easy capital, and a massive supply of desperate investors. The shadow banks stepped in to bridge that gap. When you hear the term shadow banking, your mind probably jumps to something illegal. You might picture money laundering, offshore accounts, or men in suits meeting in dark alleys. But the reality is much more mundane, and that is exactly why it is so dangerous. The shadow banking system isn't run by criminals. It is run by the most prestigious addresses in New York, London, and Hong Kong. It operates in plain sight, often in the same skyscrapers as the banks you trust with your savings. To understand this beast, you have to look at the unintended consequences of the Great Recession. After the 2008 crash, governments around the world passed massive regulations, such as the Dodd-Frank Act in the US and the Basel III Accords globally. These rules had a simple, noble goal: force banks to be boring. They required traditional banks to hold massive amounts of cash in their vaults, undergo stress tests, and take fewer risks. But here's the thing about capitalism. The appetite for risk never disappears, it just migrates. When the front door of the banking system was locked by regulators, capital found a side door. This is the shadow economy. It consists of non-bank financial intermediaries. These are hedge funds, private equity firms, money market funds, and modern fintech lenders. They perform the exact same functions as banks. They take money from investors and lend it to borrowers, but they do it without a banking license. Because they don't have that license, they don't have the same heavy oversight. They don't have to keep massive cash reserves. They don't have federal deposit insurance. They are agile, fast, and exploding in size. In 2010, this sector was a manageable concern. Today, the Financial Stability Board estimates that non-bank financial institutions hold nearly half of the world's financial assets. We are talking about over $200 trillion moving through a system that has no safety net. We squeezed the balloon of traditional banking to make it safer, but all we did was push the air into a part of the balloon that is thinner, weaker, and much harder to watch. So how does this system actually turn free money into a global threat? It happens through mechanisms that sound technically boring, but are terrifying when you peel back the layers. The primary engine of this machine is a practice called rehypothecation. To understand rehypothecation, we have to use an analogy. Imagine you go to a pawn shop and pawn your luxury watch for $100. The shop takes your watch as collateral. In a normal regulated world, the watch sits in a safe until you pay the money back. But in the shadow banking world, the pawn shop doesn't keep the watch. They turn around and pawn your watch to someone else to get their own cash. And that person might pawn it again to a third party. Suddenly, that single watch is supporting 3 or 4 different loans simultaneously. This creates hidden leverage. In the shadow system, a single dollar of collateral is often used to secure multiple bets across the global economy. Everyone involved feels rich because they all believe they have a claim on the asset, but the asset only exists once. Alongside this is the complexity of securitization. Shadow banks take thousands of risky loans, car loans, credit card debt, corporate debt, and bundle them together into complex packages to sell to investors. This makes it impossible to see the quality of the original loans. Because these transactions happen off balance sheet, regulators are blind. They cannot see the chains of debt connecting these firms. They don't know who owes what to whom until the bill comes due. It is a web of debt that remains invisible until panic strikes. When one link in the chain breaks, the confusion creates a run on the entire system, as nobody knows where the real assets actually are. The real danger of the shadow banking system is not just that it is big or that it is hidden. The danger lies in a structural flaw known as the liquidity mismatch. This is the ticking time bomb at the heart of the modern economy. Here's how the trap works. Shadow banks, like certain open-ended funds, often make a promise to their investors. You can take your money out whenever you want. This is called daily liquidity. It sounds safe. However, these funds take that money and invest it in things that are incredibly difficult to sell quickly, like commercial real estate towers, private corporate debt, or long-term infrastructure projects. In a rising market, this mismatch doesn't matter. Money flows in and everything looks stable. But when the market turns, when fear grips the headlines, investors panic. They all rush to the exit door at the same time to withdraw their cash. The shadow bank needs to pay them back, but it can't sell a skyscraper in an afternoon. To raise the cash, they are forced into a fire sale. They have to sell good assets at bargain basement prices just to survive. This is where the contagion begins. When a massive shadow bank dumps billions of dollars of assets onto the market, it crashes the price for everyone else. Suddenly, traditional banks, pension funds, and insurance companies see the value of their own assets plummet. The panic spreads from the shadow system back into the safe, regulated system. We saw a preview of this terror in 2020 during the Dash for Cash, again in 2022 with the UK pension crisis. In both cases, central banks had to step in and print billions to stop the bleeding. But next time, with inflation already high and debt levels at historic records, central banks might not be able to afford a rescue. So, why does this matter to you? You aren't a hedge fund manager. You don't trade derivatives in the dark. It is easy to think that if the shadow banking system collapses, it will just be another case of rich people losing money at the casino. But that is a dangerous misconception. The shadow banking system is not powered by the money of billionaires. It is powered by the money of the middle class. The biggest investors in these unregulated funds are pension funds and insurance companies. The teachers, firefighters, and office workers of the world are the unwitting fuel for this machine. Because pension funds need high returns to pay for your retirement, they have poured trillions into the shadow banking sector. If the shadow system breaks, it won't just be a line on a graph that goes down. It will be the solvency of your retirement fund. It will be the stability of your currency. The free money era is over. Interest rates have risen, and the easy liquidity that allowed these shadow banks to grow in the dark is drying up. The tide is going out, and we are about to discover just how unstable the foundation really is. The best protection is awareness. Understanding that the financial stability we see on the surface is supported by a fragile, opaque scaffolding. We must demand better oversight and transparency, not just for the banks we see on Main Street, but for the leviathans lurking in the shadows. The next crisis won't look like 2008. It will be faster, more complex, and it will come from the places we stopped watching. History shows us that financial systems always evolve to bypass barriers. We built a wall to stop a flood, but the water just flowed around it. Now, we have to learn how to swim. We are seeing the consequences of this regulatory blindness right now in a specific sector called private credit. This is currently the fastest growing corner of the shadow banking world, and it is the area that has economic historians and risk analysts most worried. Here's the setup. Traditional banks, under pressure from regulators, have largely stopped lending to risky, mid-sized companies. They have exited the field. So private equity firms and shadow lenders have stepped in to fill the void. They are lending hundreds of billions of dollars directly to businesses that are often already struggling with heavy debt loads. The danger here is price discovery. In the public stock market, we know exactly what a company is worth every second of the day. If a company fails, its stock price crashes instantly. But in private credit, the loans are not traded publicly. There is no market price. A private lender can claim a loan on their books is worth 100 cents on the dollar, even if the borrower is effectively bankrupt, and no one can prove them wrong until the company actually collapses. This opacity allows losses to be hidden for years. We have inadvertently built an entire ecosystem of zombie companies. Businesses that can only survive because shadow banks keep feeding them more debt to pay off their old debt. It is a Ponzi scheme of corporate survival, kept alive by the fact that no one is forcing these lenders to mark their assets to their true market value. Every financial bubble in history needs a pin to burst it. For the shadow banking system, that pin is the upcoming refinancing wall. Much of the debt currently sitting in the shadow system was issued 5 or 7 years ago, during an era when interest rates were effectively zero. It was incredibly cheap to borrow money, so companies gorged themselves on it. But corporate debt is not like a 30-year home mortgage with a fixed rate. It has a shorter lifespan. A massive wave of this shadow debt is set to mature between 2025 and 2026. When these loans mature, the borrowers have to pay back the principal or refinance the loan. But the world has changed drastically. Interest rates are no longer zero. They're significantly higher. A company that could barely survive paying 3% interest cannot possibly survive paying 9% or 10% interest. When this maturity wall hits, we are going to see defaults spike rapidly. The zombie companies mentioned earlier will finally die. When they default, the shadow banks that lent to them will take massive, undeniable losses. And remember the liquidity mismatch we discussed? When those losses hit the headlines, the investors in the shadow banks will panic and try to pull their money out. This is the nightmare scenario that keeps central bankers awake at night. A synchronized wave of corporate defaults meeting a synchronized wave of investor withdrawals, all happening in a sector that has no central bank backstop to save it. So, where does this leave us? And more importantly, where does it leave you? It is easy to view this narrative as a distant game played by billionaires and faceless corporations. It is tempting to think that if the shadow banking system collapses, it will just be another case of rich people losing money at the casino. But that is a dangerous misconception. The shadow banking system has become the circulatory system of the global economy. It funds our housing markets, our car loans, and our credit cards. But most critically, it is powered by your money. The biggest investors in these unregulated shadow funds are pension funds and insurance companies. The teachers, firefighters, nurses, and office workers of the world are the unwitting fuel for this machine. Because pension funds desperately needed high returns to pay for your retirement, they poured trillions into the shadow banking sector. If this system breaks, it won't just be a line on a graph that goes down. It will be the solvency of your retirement fund. It will be the stability of your currency. The free money era of the last decade wasn't truly free. It came with a hidden cost: fragility. We replaced a transparent, regulated banking system with an opaque one, all in the name of short-term efficiency. The bill for that fragility is coming due. The best protection is awareness. Watch the liquidity. Watch the private credit markets. Because in the world of shadow banking, what you can't see can hurt you. History teaches us one lesson. Financial systems are fragile. The shadow banking crisis isn't an anomaly. It's the latest chapter in a long story of regulatory failure. We are living through the climax right here, right now. Here at Economic History, we are dedicated to peeling back the layers that the daily news ignores. We don't just look at what is happening. We explain why. If you want to stay ahead of the curve, subscribe and turn on notifications.